Now, it's still Sunday the 9th of November 2025, and at the end of the video I did on the profit and loss account, I said I'd do the balance sheet next. That was a slip of the mind. I have to do the expenses to the P&L account next before I go on to the profit and loss account. And it's a bit chilly. I'm going to go down and poke up the fire and get a cuppa, and I'll leave it and not do the balance sheet tonight. I'll just finish the profit and loss account. I hope that was some use to you there, what I did. I never know till I get the responses whether I'm being an old schoolmaster or not. Anyway, we see now that we have a gross profit from the earlier example. In the simplified version of it, the version without the purchase and sales returns, it's 71,200. Do you see that? 71,200. See that? So that's our gross profit, but that's on our operations. Now we have to take the expenses out of that, because we don't have that to keep for ourselves. So what are the gross profit? The gross profit 71,200. That's what we already have. Now, expenses, wages and salaries 35,000. You have to pay your staff salaries. Rates 5,500. The phone bill 1,220. Bad debt. Now, if people don't pay you after a certain time, you have to recognize it. You're not going to get that money. It's gone. So bad debt is 200. Provision for bad debt. Here's the provision here. Now, if you think you're going to have every year you have a certain amount of bad debts, you have to make provision in your accounts. You mightn't be getting that. And even if you're a farmer, you might have sold a lot of hay and some fella won't pay you. He never paid me before. You might sell to 15 customers, 14 of them all pay, and there's always one lad that'll not pay or that. So eventually you have to make a provision for him. So you have bad debt here, 200. Bad debt 200. This has gone a bit bowies here. So that's the phone bill. That's bad debt. And then that's provision for bad debt 180. So this is gone, you're not getting it. This you might get it, but you're putting in a provision for it that you might get that money. Bad debt provision. Now, the next thing comes up is the depreciation. We say this is a shoe shop, so the fittings 4,000. Depreciation, you know that when you buy a thing, it depreciates. I don't know will I ever bother showing you how it works, but you have to depreciate your stuff. And I make a big issue of this about the wind farms. Normally, those things will be depreciated over 7 years, but they don't depreciate them that way. They depreciate them over 20 years over the planning permission, which means in a way that the people who grant the planning permission set out the depreciation. There's something funny about that industry, in the wind industry, but we'll not go there. So now depreciation is 4,000 on the shop, on the fittings. The van depreciation is here is 6,000. You know the van will be depreciating. It'll be worth less at the end of the year than it was at the beginning anyway. So 6,000. So if you add all these up, it comes to 52,100. 52,100. Your net profit is 71,200. So therefore, your gross profit is 71,200. Your expenses is 52,100, and therefore your net profit is 19,100. Net profit is 19,100, which is not a lot. Now, can you see that there? Net profit is 19,100. That's I think we'll what's that there now? That's only 4 minutes. Maybe I would do a wee bit on the balance sheet, but now you get the idea. Your gross profit is when you sell, what you make from your sales. You have to take out the cost of those sales and what's directly related to the cost. Now, it just occurs to me, on a farm, in my view, in my opinion, I don't know how to do this now, but the meal would be a cost of sale. That's a cost of getting the condition on the bullocks. So the meal would be a cost of sale. You with me now? Whereas depreciation on the shed would not be directly related to the sales of the cattle. That would be an expense. And I'm not going to answer you because I'm not a practitioner. It's a long time ago. I just do my own. But the thing is that a fella doing contracting, he's selling his baling. He's baling. So he gets in so much on baling. Well, his diesel oil would be a cost of sale. He couldn't cut that silage without the diesel. It's not an expense, but the expense will be the depreciation on the tractor. You get me point? So the question arises, do you put the expense in as a cost of sale or as an expense? I think I've explained that fairly well. Definitely the phone would be, well, you could probably say the phone might be used for sales, but not really. Bad debt is definitely an expense. So just to understand the difference between expenses and cost of sales. It still works out the same. If you make a slip, it's the same result you get. But rates would be one, and wages. So if you're baling the silage and you have a lad pay a lad, that's wages. And they don't put that in as cost of sales. It's not done. But if you did do it by accident, it wouldn't change the overall picture. Do you understand? Now I can go to the balance sheet now actually, because I've dealt with that all. You have your figure for your net profit. That's your net profit. Okay, that's it. That's what you made. Not a lot. Not by today's standards anyway. Maybe long ago, see. Maybe long ago it might be. Now the balance sheet is a photograph or a picture of how you stood at a particular time. Right? And the first thing goes into it is fixed assets. What you have there. Land, sheds, tractors. Even my lathe would be a fixed asset if you had it, if you're using it for the farm. So in the fixed assets, you take out the depreciation. You depreciate them. They're going down every year. There's two ways of doing it. There's straight line and there's the compound way of doing it. But reducing balance, to call it. We'll not go there now. So you put in the balance sheet the shop fittings, which say was 4,000, and you take out the accumulated depreciation to date, and that gives you a net book value. So we're dealing with the balance sheet now, and this is John Brown, or whatever you call him. So his fixed assets are the cost. The fittings on the shop is 40,000. The accumulated depreciation taken out to date is 4. So his fittings are now worth 36. That's called net book value. The van cost 30,000. The depreciation accumulated is 6,000. So his net book value is 24,000. Do you see it there? The total then is, the total of these is 70,000 there. Depreciation is 10, leaving the value at 60,000. Do you understand? So his assets in relation to fixed assets is 60,000 now. If it were land, normally doesn't depreciate, but if it was a shed, it normally depreciates a little bit. The tractor would depreciate. Good livestock shouldn't depreciate, but you get the general idea. This is the fittings. If you're a metal worker, this would be your lathe, your milling machine, your profile cutter, your guillotine, all of that, and they would be wearing a certain, so you'd have to reduce them down a bit with depreciation, and then you get a net book value, and that's, you see, the balance sheet showing you what it's worth, what's its value at the end of the year. So now, folks, we done our fixed assets. Our fixed assets, when you depreciate them, come to a value of 60,000 net book value. Okay. The next thing we have is our current assets, and that's our stock. That's an asset. Our debtors, that's money people owes us. I owe my suppliers, so they can. That's as good as gold. I pay my way, so that's an asset to them. There's a provision for bad debt, So you have to take out what, this is not fully, you mightn't get it all, so you have to take out some of the bad debt by way of a provision for bad debt. The provision is taken out because you may not get that, and that gives you 8820. You have a prepayment here. Somebody might give you money to do a job next week. Here, I'll pay you now and come and do it. 500, that's an asset. You have that. You have to deliver for it, but it's your money for now. And you have 3,000 at the bank, so that's another asset. You have money in the bank. And when you add all these up here, your current assets is 132,320. 132,320. They're your current assets, right? They're current. These are fixed. These are long-term assets. Okay. Now, so that's that. Now, what about our liabilities? What about what we owe? And I know it's getting a bit hard to see it. Now, so our liabilities, creditors, people we owe money to. So we'll say that the creditors is 7,000. Expenses accrued, expenses building up that we have to pay. That's, we'd say, 5,220. So now we have our creditors, people we owe money to, and expenses that we have to pay in the immediate future, and that amounts to, total of them is 12,220. 12,220. That's our current liabilities. These are our current assets. And you calculate these, then you take your liabilities from your assets and you get 120. 120. Okay, so that's your working capital. That's your current working capital. And so you add that working capital, that's assets, to your fixed assets of 60. You have that as well. And when you add the 160 to the 120, you get 180. So you have 180 is your position. That's what your whole thing is worth. Do you understand? Just to go over it again, you have your fixed assets. There's several other things goes in there. You have your cost, your depreciation, and your net book value. You have your current assets. You have your stock. You have debtors that people owe you, less provision for bad debt, which you may never see, giving you the proper debtor figure. You may have prepayments of 500. You may have money in the bank, 3,000. You add these up and you get 132,332. And then you take your liabilities. You owe money to people. You have creditors. You owe them. You have expenses that's accruing up. They're coming in there all the time, whatever they are. And so you have 12,220. So you take the 12,220, what's your liability, from your asset 132,330, and you get 120. You see it there, 120,000. Now that's an asset, and these are assets. So you add the 60,000 to the 120,000 to give you the 180,000. That's the first side of your balance sheet. Right, folks, it's really getting chilly now, so I'll have to hurry it up. So we see here that we have our fixed assets. We have our current assets, we have our current liabilities. We take our liabilities from our current assets, and that gives us our working capital, and we add our working capital to our fixed assets, and we get our balance, our figure for the top of the balance sheet, 180,000. So when you count our fixed assets and our current assets, whatever we have, less liabilities, it's 180,000, okay? And the working capital is 120, but if you add in your fixed assets, your van and your shop fittings, it's 60,000. That gives us 180. And that figure has to be balanced. And I'm now going to balance it now. So now we see that we had 180 here for our fixed and current assets. And we know, how is that financed? How do we pay for that? So the first thing is it's own capital. You put in that much money out of your whatever you sold or something, or you have shares, or you got, it's not a loan. If it's a loan, it's a different thing, but there's no loan here. This is for simple. So you put in 179 of your own money into this venture, right? That's how you financed this here. How is this financed? Okay, and how do we get this going? Now, the next thing goes in here is the P&L account, the profit and loss account. Now, do you remember when we did the P&L, the profit and loss, we had a net profit of 19,100. That's brought across to the balance sheet. That's brought across to the balance sheet. Do you see that? And I think it's the only thing that's brought across to it, but I won't just pin my reputation on that. So we then had 19,100. So we paid invested 179,000, and we're making a bit of profit, and we bring that into the balance sheet from the profit and loss account. The profit and loss account is over a year's period. This is a snapshot at the end of the year. So we add the 19,100 to the 179,000, and we get 198,000, and you draw a bit. You normally draw money from the company, so you drew 18,000, and that left you 180,000 there. And that 180,000 for your finance buy has to balance with the 180,000 of your assets. These are your assets. How were they financed? They're financed by your own capital, or it could be 179,000 ordinary shares paid in to the company, and it could be then the P&L account. Now, I be on about the wind farms and about the share price and all of that. They're financed. They can be financed by shares, or they could be financed by a loan or whatever. It doesn't matter. You can't start a company without investing something into it. It's as simple as that. How are you going to get your shop fittings or anything else? You can't. If you pay it out of your own pocket, then you're paying it. If you're a farmer, you have to invest something in. If you inherited the farm, you may have to pay some tax or something inheriting it. Or if you bought it, that's it. That's how it was started up. So if you're a farmer, that'll be your capital. You'll have your own capital got in there. You bought the farm for 179,000 whenever, and then you have your profit and loss account giving you a bit of profit every year, and then that gives you the total here, and you take out a bit of drawings for your own running your own show, maybe having an odd meal or something, or feeding or whatever you're doing. Drawings, that's not connected to the business. This is personal drawings, and that gives you 180,000. That was the figure you had for your balance sheet over here. The figure you had for your current assets and your fixed assets, and they must balance. There has to be 180. Folks, it's cold. I'm getting cold. And I have no cap. I noticed this now. I want to go down and put on a bit of heat and get myself warmed up. Have I helped you with that? I don't know whether I'm wise doing that or not. Maybe I'm mad in the head. I don't know. It's one of them things, but I think it is a bit valuable to show you how it works and how your accountant, if you have one, will be doing it. That's the way it's done. There's a good few other things I might do again or something. There's intangible fixed assets. And one of those is where you'll get a vet retiring. He won't, if he's a vet in the area, he won't, he has all the names, he has all the everything. He won't necessarily hand over his business to you unless you pay him something. So he might say, I'll give you the goodwill of it. So he might give you 100,000 for the goodwill of your practice. And that gives him the right to everything. And that's goodwill. And the new company carries that on their books as an asset. It's an intangible fixed asset. You can't touch it. And it's amortized, it's depreciated. So after a while you build up your own reputation and you don't need your predecessor to promote you. Do you know what I mean? It's the goodwill. You get the books, you get everything, and all your post comes to you that he was getting before, and the department deal with you directly. And so you don't have to just come along and start off as a new vet. You can do that, but you don't have to do that. That's what goodwill is. Might deal with it again. I did a thing on the course on it years ago now, and it got she says that's the best. She says to me, can I use that for my students? I had it done with a vet retiring and selling his goodwill, and the new vet buying the goodwill, and then over a period it dies out. The other man might be gone, he might be dead and buried, it's no good. But for the first couple of years it's a help, and that's an intangible. You cannot touch it. I think patents are another one, an intangible fixed asset. But they all go in here. They still all go in to the assets over here. So instead of having, you'd have fittings and you'd have the van, you'd have goodwill at a certain amount, and that's amortized the same depreciation. So every year, if you paid 100,000 for the goodwill, you'd take maybe 10,000 a year. Really, after 10 years, you wouldn't have much goodwill left, and that's called amortization. Anyway, we let you go, folks. I'm cold now. I hope that's useful. 20 minutes, not too bad now for 2 videos, and we'll make nothing else. Bye bye. Thank you.